So I started my professional journey, and I've been a serial entrepreneur throughout. But I started, just before 2000. So it's almost close to about 25 years since I've been a founder or involved in the startup ecosystem, starting with India Mart, and then moving on to founding 4 more companies across classifieds, finance, e-commerce, and now travel. Um, yeah. But on the investment side, I've been an active investor since 2005, where I started my SIP, and I've continued, that SIP for close to 17 years now. I've not missed a single one, a single installment so far, and just from a discipline and consistency perspective. Also, I started angel investments sometime in 2014-15, when after a little over a decade, I thought, why not go back and give it back to the ecosystem where I've learned a lot from, where I've become who I've become because of this ecosystem. So I wanted to give it back to the ecosystem, and eventually I've invested in over 100 companies. And what I've learned, or what's one key learning for me over the last 25 years of this life, is that while we spend a lot of time looking at managing the company, its growth, capital for the company, we sometimes tend to overlook what we need for ourselves, for our families. So as founders, or as senior professionals, or people who are working in corporate life, you need to balance what you're doing professionally, but also you're looking to stabilize your personal and family wealth, wherein it could be from angel investments or from public market, but you need to be present there. You need to start investing, and not just working and not looking at the investment side of it.
That was awesome, Pankaj, explaining your journey and how you went from listed equities or public market to eventually unlisted space. Now, I believe most people start with listed space in India, and then eventually they graduate, they become seasoned investors. Now, Krishnan, what is your view? If you can also introduce yourself and what do you guys do, and what is your opinion on listed versus unlisted space? How should investors look at it?
So yeah, hi. Thanks for having me on this event. Just as a background, I'm Indore as well, 2005 batch. I spent 13 years in Deutsche Bank on the corporate banking side before me and 3 other founders started off Agria Capital. We are a SEBI registered PMS, and we manage about 550 crores of assets across about 300 clients. So on the personal side, happily married with a wife and 2 children, and I'm based in Bangalore. So if I were to go back in life and change one thing, right, is I am now 43, and when I was 25, the first thing I did is I invested money in one house. Then as I started making money in the bank, I started buying another house and another house. Ultimately, my equity journey started very late, though now I'm actually running a equity firm, and I have seen the upside in doing equities. There is no other asset class as good or as liquid and as equities in terms of returns and the risk that you take. So definitely one should start this journey and start it early. I mean, I hope a lot of our listeners are going to be young people in their 20s and just starting their careers, etc. So definitely, I hope all of you have started, or if not, you should start now. That would be my starting point.
Thanks, Krishna. Now, before, the objective of this webinar is just to keep it very informal. Yeah. So we'll be getting a lot of questions. And the idea is we don't have a preset menu or agenda, like we'll talk about those questions. So it's a very freewheeling session. So guys, please feel free to ask questions. Whatever is relevant, we'll just ask both Pankaj and Krishna. Whatever I think is their expertise, or they can just pick the questions as they want. Just to start and set the ball rolling, Pankaj, since you have also invested in public equities and then for the past 5-10 years investing a lot in startups, how do you evaluate early stage startup? I'm sure you have an investment thesis and you have a way or a strategy to build your portfolio. Now, if you can just explain anyone who wants to become an angel investor, or someone who's also already investing in startups, but is not sure how to go ahead and build his portfolio? Any advice? What do you look at? How do you evaluate companies?
Right. So I'll largely invest in B2B SaaS companies or companies that have a clear line of revenue stream, either on the present day or sometime in the future. Um, that's one. The second is that are these companies going to make a significant impact in the market as and when they become mature? Which means that is there a significant demand, whether latent or active, for the consumers or for companies if they are operating in the B2B space? Uh, will there be enough impact as they mature? Is the second criteria. In terms of specifically evaluating a company, the first and the foremost I look at is what's the founding team looking like and how committed they are, right? Which means that if I have to choose between two companies where there is a team which is 100% committed to the startup, they are full time. They've actually either thought about the idea or they've started executing, versus another company where the founder says that look, I'm still in my job, but if I get the funding, I will become full time founder. So if I have these two options, I will take the first one. So that talks about what's the commitment level of the founder, because I'm going to invest in the founder, in the company, and if he's committed himself, if I see that passion in the founder, that gives me a lot of trust and comfort when I'm making that choice. The second thing that I look at is, are they repeat or first time founders? uh, Essentially what I'm looking at here is that if you're a repeat founder, you've gone through the journey the first time in terms of the highs and the lows. You've seen how companies are built, what happens on day one versus what happens after you've raised investments or you've had your first client. So you're attuned to living that life of that high and low, versus somebody who's new may not be. And it's a very generic statement. It's not specific to each individual, but largely you would see that a first time founder versus a repeat founder, the repeat founder will have a lot more comfort and confidence going through with a second startup. The third thing I look at, and this is one of the most important thing that I feel is worth looking at, is that whatever company that you're going to build, is it going to be the right time and the right place for the company to operate? Which means whether it's the tailwind industry, whether there are certain micro or macro factors driving that company forward, versus if it's a headwind industry where the macro factors are trying to limit its scope. So if there's a right time and the right place for the company to operate, it it sort of gives me the confidence that yes, the founding team is right. The company has the best time and space to operate in, which means that it's a good enough risk to be taken. Now, if it's a pre-seed to a late stage company, it doesn't matter. But I think to me, these two are the most critical components. Um, then we also look at what is the TAM looking like, what's the total market scope, because sometimes you have good companies but the market potential itself is small, which means that there is no enough upside as investors for us to participate in, while the company can do well individually or bootstrapped or with limited funds. But as investor, I would try and avoid that company. And eventually, as like we are investors, we're looking at what's the return possibility from that company. So if I see that the company has a potential of giving me a fund returner or a 100x return, that makes it even more sweet.
So a lot of interesting opinions, Pankaj. So we'll just keep return towards the last because everyone is interested in that. Now you spoke about three things. First is revenue. The startup should be making revenue. Second is impact. Third is founder. And also you talked about the right macroeconomic background. Now, Krishnan, coming to you, like now all listed companies have revenue. So revenue is of course maybe not a criterion for you, since revenue growth could be one. But what are your criteria when you look at investing your money or your investors' money into listed companies? How does that compare with what Pankaj said about the unlisted space?
So there are various ways to skin the cat on the listed space. One has to really decide based on the time available to the investor, right? In terms of how much time you commit and study the markets. So you have fund managers, or you have people who make money using a value approach, right? Primarily, we can split it into 4 or 5 buckets. So one is a value approach where the objective is to see if there are companies which, in your sense, are not or don't trade at a price at which they are supposed to be trading, and you see an inherent value in that company. So you try to buy companies which are basically cheap from your perspective. The second is a growth approach wherein you try to shortlist companies which are high on growth, which are consistent performers, which have done well in the past, who return a great return on capital employed, right? So that is one approach. The third is a momentum approach where you use technicals, a bit of fundamentals, and try to find out which are the companies where the prices are really going up so that you can ride the wave. There, of course, timing in terms of entry, exit is very important. And fourth is like a sectoral approach where there different companies do well in different points in time. There are cyclical industries, there are macroeconomic conditions which impact different industries at different points in time. So there are different approaches. The point is, if you are just a retail investor, right, it is difficult for you to spend that kind of time and energy. So you should probably just do a mutual fund or a PMS or whatever. But if you have time, then you should look at one of these approaches. Value approach, of course, has been and these are all like, these approaches have been there forever. So you have to basically choose as to what and stick to that approach, right? And over time, you'll be able to make money. So, for example, one simple thing you can do, like even in India, there are 7,700 listed companies. But actually, if you see which are the guys who have been genuinely or on a sustained basis providing a good return on capital employed, have had a great sales growth over the last 10 years, for example, or have been consistent compounders, so to say, in terms of their performance, ROC, sales growth, etc. If you apply these basic filters, you will be surprised, but you'll end up with 50, 60 companies which have been sustained performers over multiple years. Obviously, most of them will be the blue chips, etc. So even if someone were to create a portfolio making these basic rules and end up with, say, 20, 30 companies and invest in them, you will still end up with a good CAGR over a period of time. So short answer is there are different approaches. One should choose an approach. And if then one doesn't have the time, then of course one should go with a mutual fund or an index fund, or of course there are other options like PMS, etc.
So if we were to just so Krishnan, you talked about so many different approaches. Now, one approach you mentioned is growth approach, where you invest in growing companies and you look at the past, especially the metric called return on capital employed, or you can use a similar metric, return on investment capital. Basically, how much value are you getting for the capital you have put into that startup?
Yeah.
Now, Pankaj, what I have seen is also in startups now, a few investors are using similar metric. Now, of course, in startup there is no profit, but maybe you can use revenue as one of the indicator. That how much capital you use to reach this kind of revenue. Is that something you use while evaluating startups, like how efficiently these startups have used capital in the past?
Yes, that's an indicator. But in a startup, there are different stages. So if you're looking or evaluating pre-seed to early startup, you may not have that kind of numbers to indicate. So I would divide the spectrum of startups for the benefit of the audience into two parts. One is, let's say, it's pre-revenue, or it's largely very early with limited numbers, versus the other stage where you have all these numbers indicating themselves. So when you have these numbers available, yes, we do look at how the founder of the team has utilized the capital that they've raised in the past to reach where they have reached. And when they're raising a new round, what's their goal with the new capital that's going to come in? How efficiently are they going to utilize this capital? Which, for simplicity's sake, means that for every 1 rupee of capital raised, what's the goal that you're looking at? If it's revenues, then for every rupee that you raise in the market, what's the revenue projection that you are aiming to reach? If it's technology that you want to build, or your IP that you want to build, then what's the likelihood that for every rupee that you invest, that you will reach there? So you look at what's the fundamental success parameter of that company, and will the capital help that company reach where they want to reach with this round of funding, and some indications of how they performed in the previous rounds. But that's more for late growth and mature companies. For the early ones, we largely look at how the founding team is the composition is looking like. So if it's a company that's aiming to disrupt a technology, or solve a problem through technology, does the founding team have a technology person as a co-founder? If it's a company that's aiming to solve a distribution problem, then is there a person who has had experience in distribution or operations, part of the core team? Similarly, what's the core principle on which the company is founding itself? Is the founding team built with that experience as part of the team? When you don't have any other number to look at, there's another a very secret way of how I perceive and how I evaluate is, suppose I was looking for a job and this startup came to me and pitched itself that, boss, we have a vacancy and you should join. Will I, and should I, and do I get that feeling that I want to join this company, work for no salary, only on equity? If the answer to that question is yes, then that means I am sold to the passion of the founding team of the company, driven by how they are aiming to be to reach where they want to reach. So that's one parameter I use, when I don't have any other on ground numbers to look at.
So the feeling I'm getting, Pankaj, is startups is a lot more about founders. Like you're basically, at least in the early stages, you're banking on the founders, not so much on the product. Of course, product and revenue is important, but it's basically the founder who makes or breaks the company, right? Am I correct?
Right, absolutely, because they are the ones who are going to build right from scratch. So you need to know, and you need to believe that the people who are behind this idea, this grand idea, this grand vision of eventually disrupting the existing players, the incumbent players, and becoming unicorns and decacorns, you need to be with the right set of people, right? And then that's what you do in the family also. You, when you are going and you know uh, maybe looking for a spouse, you, what you look for in them is that, can I spend my entire life with him or her? Can I see that life happening, right? It's essentially you're evaluating that long journey with somebody. uh, it's not so much of what will happen in the first year or the second year or the nth year, but really, do you get that vibe? Do you get that comfort of working with somebody over the next 5 or 10 years that you want to remain as an investor? So yes, to me, founding team is one of the core principles and the key decision making parameter.
So, Krishnan, how important is that in the listed companies, the management profile? So, we always hear about people like Warren Buffett and Charlie Munger talking about, hey, we talk to the management, understand the business. But for ordinary people like us, Mukesh Ambani is not going to speak to us. So, is that even a criterion for you? And if yes, how do you evaluate that? The promoter background, management.
It is definitely a filter, but you're right. Our first filters would be on the finance side, right? And ultimately, whether to add a company into a portfolio or not, the management is going to be another criteria. So there we look at multiple things, right? Unfortunately, not only in India, even globally, most of the companies are family owned, and the son or daughter becomes the hire, etc. So those things are difficult questions to answer in terms of their competence, capability, etc. But once a company has a strong management, a broad and strong board, and all the board information, etc., is publicly available. And there is a track record in terms of their performance, disclosure norms, how detailed their annual reports are, etc. These clearly signify, the quality. There are some, for example, private companies which are part of, a family group, for example. So they don't need to give disclosures, but those promoters even disclose even for those private companies. Classic case I can give you is like Wipro, right? Wipro Limited is a listed company, but Wipro Consumer is an unlisted company. But if you go to Wipro Consumer, you will get all the information you want, like you get in Wipro Limited. So it also speaks volumes about the quality and the the inclination of the management to disclose information. So that gives us a lot of comfort. Having said all this, you can't avoid accidents, right? Because in India, or even outside, right, fraud can never be, or it's very rare or difficult to detect fraud. Leave alone in private equity, it's a much bigger problem. But even in the listed space where all the information is publicly available, still, even today, people are not able to solve whether the FII investments in Adani is real or not, right? It's a Nifty listed company, so we don't know. So we can't. So where you're not comfortable, there are other options, to be honest. So you don't need to take those risks. Secondly, you have to. I'm just answering one question also. I think it's from one of the participants. How do you diversify, right? Or do you need to diversify, right? Clearly, you cannot have a risk of more than 5 or 6% in a particular stock. Now, whether your investable surplus is 10,000 or 10 crores, right? You have to always ensure that you don't have more than 5 or 7% in a single stock, so that no matter how great the company may be, if things go south, you can live with that loss. So yes, we can read about it. We can take the comfort through the softer aspects. People can listen into the companies they have invested. You can listen to the quarterly calls and get a lot of comfort. Like recently, there was one quarterly call from Sun TV where they were not able to. The CFO couldn't explain why there has been no increase in salaries for staff, but the promoters are taking a crazy number home. So these kind of things can clearly show you what's comfortable, what's not, and you should, if you can spend that kind of time, you will get these uh, data to take those calls. Otherwise, anyway, no matter how good the company, you should limit your exposure to 5 to 7% of whatever is your investment.
And all this data is available publicly for listed
Yes,
companies.
absolutely.
Annual reports, quarterly call, and you use that information to assess the
Yes.
and the promoters, what kind of person are they.
Yes.
Brilliant. Now you also talked about diversification, and I think that is one topic everyone really wants to know. Like how important is like everyone I think knows that diversification is important because we have always been taught don't put all your eggs into one basket and all these kind of things. But both for you, since Krishnan, you advise people on public equities and Pankaj, since you invest in both, how should you go about building your portfolio? Like at what stage you should say, hey, I have done enough of listed equity. Now let's move to private equity. And then how to move to private. First of all, how do you build your listed equity strategy? Then there comes a point when you say, hey, I have enough. Now I have put enough in public space. I should diversify a bit. And then how do you build your private equity strategy? So both of you, like, I would like to have both your opinions.
Yeah, I'll probably start with the listed space and then Pankaj can take it
Yeah.
from there, because sequentially, both of us think, we've spoken about this earlier, that you need to reach a certain stage in terms of your capital before you venture into private equity, right?
Do you
But
agree,
listed,
Pankaj?
Yeah,
Okay.
but
we've
listed,
all gone through that journey ourselves.
so listed you can start with 500 rupees per month. So that's the difference, right? So clearly you should start with SIPs. I have one interesting data point here, right? In terms of, if someone were to look at, the timing is a very, we can discuss this later, but timing is a very big issue in investments, right? Markets go up and down all the time. But let us say you take the 2008 financial crisis, right, where markets fell 60%. If somebody had started an SIP just at the peak of the bull market before the crash, versus somebody had started an SIP at the end of the at the beginning of the bull market after the crash, right? So we would think there's a big difference, but over a 13-14 year period, the CAGR per annum is only about 0.6, 0.7% difference, right? So somebody would have made 13, other person would have made 13.7%. So SIPs over a long term will kind of even out. So everybody should start with an SIP. Another interesting point is a lot of us invest in mutual funds. So coming to the diversification point, diversification doesn't mean you have to have 20 MFs, because ultimately the MFs also invest in the same companies. So you may end up just duplicating your portfolio by investing in 20 mutual funds, because if you invest in 5 large cap funds, there is a 80-90% probability that all of them will invest in the same set of companies. So I would say people should, investing in mutual funds, should look at maybe 2 large cap funds, 2 mid cap funds, 2 small cap funds, and if you have a view on sectors, maybe one sector for the next few years. That is enough. You don't really need to have 20-30 mutual funds in your portfolio. That is not diversification. Second is on the large cap funds. Most large cap funds, this is also a good data point, but almost 80% of large cap funds don't even beat the index, right? So even if you just do a Nifty ETF or a Nifty MF, that should solve for your large cap exposure. But you should diversify between large, small, and medium cap. Maybe 1 or 2 funds in each of them, and that's it. So, and as you build your portfolio over a few years, right, and you make money and you have money, then you have other options like a PMS where the minimum investment is 50 lakhs. There are many players, including us, so that's an option you can look at. And once you grow your corpus even higher, then one can look at other options like AIFs, which are again variants of what we do, but where the minimum investment is about 1 CR. These are regulatory minimum. So that is how I would advise someone to start their journey. Have a diversified portfolio. Definitely do your SIPs. Build your portfolio, and once you have the money, look at other options like PMS or AIF, and then private equity is what. Then over to Pankaj.
No, just 1 second. Since we're on this topic of diversification, I talked about PMS, AIF, and so there was one question someone wanted to understand the difference between these three mutual funds, PMS, and AIF. And if you are at the highest tax bracket, what should you pick? Should you pick PMS or should you pick AIF? What is your view on that?
So on equities, thankfully there is no difference in terms of the vehicle. Briefly or at a high level, the difference is in a mutual fund, you just invest and you get a daily NAV, right, which will show the growth, and you really don't know what's happening behind the scene. They are investing in 20 companies, 30, 50 companies, whatever, and all you see is an NAV. And in terms of taxation, on a long-term mutual fund, you end up paying 10%. 10% on short term, you end up paying 15%, and long term is more than 1 year. Short term is less than 1 year. The same thing applies to if you were to buy stocks directly. Now, what does a PMS do? A PMS is just a vehicle where somebody else does that work for you, where you open a demat account and you give the power of attorney to a fund manager, and he buys and sells the stocks on your behalf. So everything is in your name, but then he does the work and he or she gets the fees for that. An AIF is different because it is more similar to a mutual fund than a PMS, because in an AIF, the stocks are not in your name. You just give the money to the AIF, and then again you get an NAV like MF. And why PMS or why AIF, why MF? MF is easy for everybody. Retail, as I said, you can start with even 500 per month. So it's the most common popular vehicle because it's available to everybody, and any ticket size is doable. PMSs are more or AIFs are more customized investments where the approach is very clear for you, and you have access to the fund managers, and it's a more customized solution for you. For example, most mutual funds are very diversified, right? There are mutual funds like HDFC top 100, which are 100 stocks, right? So again, over diversification is not going to will cost you returns, right? Diversification is required, but over diversification will impact returns. In a PMS, you have different fund managers having different approaches. You could have somebody who takes an aggressive approach where we may not have extreme diversity. We may have a very focused portfolio of 10 stocks instead of a 30, 50, 70 stocks in a mutual fund. So you take a little higher risk, but you'll end up with a higher return. The idea of or the objective of the PMS is or a AIF is to give you returns superior to the benchmark. So if you look at benchmark BSE 500 or Nifty in India, historically it's delivered about 10 to 12% return over a long period. A PMS or AIF should give you more than that. Otherwise, they should not be in business. Mutual fund returns so far have or historically, if you look at mutual funds, they are in and around benchmark. Many of them underperform, so you have to be selective in terms of which you choose. So if you are looking at if you're a beginner starter investor, obviously I would always advise you to start with mutual funds, and over a period of time you can expect return benchmark. um, for more advanced investors, there are other vehicles available like PMS and AIF.
Just
All right.
adding on to just
Sorry,
adding on to
Pankaj.
what Christian said, and this is my experience, how I've moved on from being a SIP investor in mutual funds to more PMS and AIF is that once I'm in the market investing in a company, either through direct or mutual fund, I have taken a risk, being present in the market. And once I've taken that risk, it's better for me if I get a higher return compared to whatever instrument that I've invested in, which means that if the risk variable is neutral, mutual fund versus a PMS or an AIF, if you have enough experience and enough capital, uh, I started gravitating more towards PMS and AIFs because the additional return that they were generating sort of increased the overall, uh, you know, the corpus that I was building without taking too much of additional risk, uh, just by being present in the market already.
So you're talking about public listed space AIF, not
Yes,
private equity, not startups.
yeah, public markets.
But startups also have a very common AIF structure, right? So they are like, sorry, just to go back to the original question, when Krishnan said there's a point when you say there's enough diversification in public markets, you don't need to over diversify. Maybe then can private equity play a role in diversifying to a different category? And what is that level? When does that inflection point comes?
Right. So first, let's understand what is startup investment and why do we get into it. One, it's private, it's early, and it means it comes with a certain set of illiquidity, uh, and it's a longer horizon investment. It's a bet that you're taking on an event going right after a certain number of years. But if you take all of this risk, the return that you get will largely and should largely be higher than what is available in the public market. Then only it makes sense to be in the angel investment space, right? Otherwise, why would you take that much of risk, that much of liquidity, and still not be able to generate better returns? So from that angle, angel investments tend to give, um, say, more than 25, or for good investors about 30 odd percent return. Otherwise, on an average, you're looking at about 24-25% pre-tax returns from angel investments, which is the difference if you're looking at mutual fund historically generating about 13 odd percent. So you're looking at almost doubling your returns with participating in Indian investments. So that's why you you should and you could look at diversification between public and private markets. Now, when you're looking at angel investments, there also you need certain diversification, because this space is based on a certain future event in terms of liquidity. You have to build a portfolio of, for example, 20 companies to begin with, because you don't know which company will be the biggest company in your portfolio, or is going to be the fund turner. So you have to build a portfolio or plan to build a portfolio from day one. So let's look at that portfolio being 20 companies, which you invest in over a period of 2-3 years. But if you on an average invest about 5 lakh rupees in each startup, that's 1 crores of angel investment money that you need to keep aside, like I said, over a period of 2 to 3 years. Which also means that in terms of your total corpus, this portion, this 1 crore, cannot be the majority of your investable corpus. Ideally, it should be about 20% of your overall corpus. But if you are, if you have certain backing, or if you are very comfortable with any investment, you can, instead of 20%, you can look at 40-50% of allocation into private market. But essentially, the point I'm getting to it as is that you should look at 2.5 to 5 crores at least of investable corpus if you want to participate in angel investment and not lose sleep over it, because the cycle of an angel investment is about 4 years to 8-9 years, not earlier than that, definitely. So the money that you invest in year one should start giving you returns at the end of year 4 or 5, either through subsequent rounds of funding in that company, or the company having gone IPO, or any other liquidity event that's going to happen at the company's level. So if you're diversifying, one, you look at how much investable corpus you have. Second, are you comfortable putting that much corpus, say about 1 crores, for 4 to 5 years of illiquidity, and you're comfortable with it, right? Because there is so much of illiquidity here, you cannot sell the company on the day that you want. You cannot go and say in year 2 that I want to sell the company, unless the company comes to you with that opportunity. So it's a wait and watch. It's a longish journey compared to public markets, and it means that you should have a better and a higher risk appetite and willingness to wait for a longer time.
All right, brilliant. So I think you spoke about 2, 3 very interesting points, and I have some questions on that. One was about liquidity. Second was also about the return you should expect as an investor in startups. Now, the entire premise is, since startup investments are more illiquid, in fact, much more illiquid than public investments, the return expectation should be higher. Now, you mentioned that 25% threshold, since public markets give, say, 12, 13, 14% on an average historically. And the right time to start is, say, if you're targeting 20 investments, 5 lakhs each, 1 crore surplus, it should never be more than 20% of your entire portfolio, entire equity portfolio. So that means maybe 4 crores in public equity, and then maybe additional a crore in startup. That's what broadly we are looking at. What are your thoughts, Krishnan, on these two? One is, how do you allocate your portfolio between private and public equity? What is the inflection point? And second, what is the liquidity premium that justifies this? What is the premium that justifies this illiquidity risk between public and private markets?
Yeah, so the good and bad is, obviously public markets are very liquid, right? So you can sell at a moment's notice, and you can take your money out immediately. But equity being equity, just addressing another person's query, is that timing is important, right? You could have ended up selling your portfolio when COVID happened and lost 40% of your capital. So timing is important. So in general, I would say, and I can speak on behalf of Pankaj also for this, is whether it is your equity or whether it is your private equity capital, it is your long-term money, right? Don't invest all your savings into it, obviously. What you need in terms of contingency, in terms of liquidity, etc., should not be invested in whether it is public or private. So within your portfolio, you should ensure that whatever day-to-day or next month or near-term contingencies are not in equities. Obviously, you can do it in debt on the term side. Please keep money which you don't need. Of course, you can never say never, but with whatever data available today, whatever money you don't need for the next 3 to 5 years is what you should definitely invest in equities, which is where if you already have a corpus, then you kind of decide how much and then you allocate. If you're building a corpus, obviously SIPs is a good way. Do a number that you're comfortable with and you don't need to touch it. However, from a liquidity premium perspective, there is a premium. As I said, in equities, just blindly closing your mind and investing in the index has been able to deliver 11-12% in the past. If you go more specific, stock specific, different strategies, you apply the time research, you can even take your returns much higher. Professional traders do generate returns in hundreds of percentages. But as a retail client, one can expect to make between 10 to 15% on equities. On PMSs, we try to do more. But that 30-35% is not sustainable or is difficult or it carries too much risk, and which is why you have other options like startups. But so the liquidity is a big cost because clearly your money is locked in, unlike public markets, and you can't really take it out even if you want to. At least in public markets, you can, even if it is at a loss, it's an emergency, you need to take the money out, it is available. So it is a rich premium that you're paying on liquidity. So you should be clear that you're allocating capital which you don't need for any contingency.
All right. So the gist of it is you should first keep some money in liquid assets, then only invest in equities. And after once you have built a larger portfolio in equity, you should move to private equity because it's even more illiquid. And you also talked about timing the market. Now, for most of investors, it's almost impossible to time the market. That's what we keep hearing. Like if you're doing investments in public equity, you should just do like you said, sit. You should not really try to time the market because in longer runs, markets eventually go up. That is what has happened over the past, say, whatever, like 50, 60 years or whatever data we have. Now, you also mentioned about large caps versus small caps. I'm assuming small caps are riskier assets because there is a higher chance of company maybe going down or not doing well, the stock becoming worthless. So is Pankaj small cap the right metric for, say, a startup equity if we are comparing it? Or should we just compare startup investment to a broad, say, BSE or whatever NSE index? Or should we compare the return in startup to, say, how the small cap stocks have performed? What are your views on that?
It's one, looking at the broader BSE and NSE market, the larger companies is definitely not comparable. Micro and small listed companies are in some way an indicator and comparable to startup, but not really a direct connect. What you're looking at is, again, from perspective of time, right? If the returns from a listed small cap were comparable to an unlisted startup, again there was no premium attached to going in the startup space. You would much rather be comfortable and getting a similar return in the public market space. So from there also, if you're comparing the small cap, you need to assign and expect that premium for the illiquidity and that period that you're taking, which is, like I said, 5 to 7 years, and that premium is not available largely in the public market space. However, there are certain black swan events like pandemic where you could, if you invested in the right time, you would have gotten a startup kind of returns in the last 1.5 2 years. But these events are less and spread over a period of time. You can't really know there's a black swan event in the beginning. In hindsight, you could figure out that yes, this was an event that I should have participated in more. But unlisted doesn't compare to that. So I would, when I'm making angel investment and startup investments, I only look at and compare it with my existing portfolio, which means because I have a certain portfolio built in, there are, with the same capital, there are two options available to me. One is to evaluate a new company and invest in that company, versus let's say some of my companies have started doing well and they've raised subsequent rounds of funding. So there are always some company which is raising their next round. So my second option is whether I want to double down on my existing investments. So when I'm making that, or when I have these two choices, that's where I compare and see that for the capital that I have available, should I go into a new company or should I double down on my existing one? I think that's, to me, is more in terms of purely numbers, is more comparable.
Because you know what you just talked about doubling down. Someone asked away. By the way, do you guys have 10 more minutes? We already 12:25. Can we do it like? I would like just try to take 3-4 questions. There are some really interesting questions.
Of
So
course,
one
sure.
is Pankaj, when you talked about doubling down. So someone wanted to know that first of all, how do you decide valuation? That is this the right valuation to invest in early stages? And in what companies you decide to double down? You decide to say, hey, I invested in 10. Now maybe 5 or 6 are raising the next round. 6 have survived till the next round. Now, do you double down in all 6 of them? And if not, how do you decide where to double down, where not to double down?
Right. So on doubling down, what I look at is in the subsequent rounds, and from the time that I invested to that subsequent round, how has the company performed? Were they able to achieve the goals that they had aimed for in the previous round, and how easy that journey was? That's one. On, do they have new investors lining up with capital? What's the quality of the co-investors? What's the quality of the VCs that are coming in into the subsequent rounds? If that quality is very, very good, if they've been able to attract top-notch VC companies into their cap table, that's a very strong indicator for me to double down on my opportunities. Versus a company who largely struggled with raising their fund. So if they started out raising fund in month 1 and they've been able to raise only after, say, month 18th or 24th, it's again an indicator of how they are being perceived in the market. So that's again on performance, on the quality of co-investors. Third, I reassess the market. Is that market still in the same shape, or going as per my expectations? Is it still a tailwind? Is it getting better, or is it getting worse? If the answer to that is a positive, then all of these three combined helps me decide that I want to go for a doubling down on that company. But there's a caveat to that. Not every company will have that option to double down. So when you're investing in, you should always check if you have the pro rata available with you. If you will have an option to invest in the subsequent rounds, and that comes from who have you partnered with for your investment journey. If it was a direct, then it should be built well into your agreement. If it's through a syndicate or a pre-pooled a fund, what's the quality of those syndicates and those funds? Have they been able to make themselves a mark into the market, and will they be able to get you that pro rata eventually when the time comes? So that's on the pro rata and doubling down on the investments.
And your thoughts on valuation? How do you? Because I think in public markets it's really easy. You have like 5-6 metrics. You have maybe price by earning, or you have ROIC, ROC. How do you assess? Is this the right valuation? Is this overvalued, undervalued? Can you even find undervalued startups like in public markets, where there's an entire industry built around finding undervalued equity?
And so this is very interesting and very subjective, because there is no right answer to this. To me, if it's very early, say a pre-seed or just starting out, what I normally look at is the amount of funds that they need to set that company up for about a 24-month life cycle. That means that they should be able to sustain themselves with this fund for the next 24 months. And whatever that fund amount is, I usually divide it by 4 or 5, which means that the entire dilution for the founders should not be more than 25% in any case. Otherwise, in the subsequent rounds, they get diluted so much that it becomes a problem of who owns the company, and the founders losing interest into the company. And we've seen certain instances in India and outside markets where the founders' equity went so low that it just didn't make sense for anybody to own and drive the growth. So if it's early, I usually look at the fund and the dilution that the founders are taking. If it's coming in with certain numbers, so if it's a Series A or Series B where they've shown a certain level of revenue, I go and look at a comparable public market company and see what their usually multiple is. Or if it's a private market comparison, then what's the valuation and the multiple that other companies in the same space have been garnering, and you try and see if the, the current round of valuation and funding is it in the same range as somebody else. The third is, again, because it's a startup and the liquidity is not happening today. The the bigger bet is on, again, the founder, and they have shown certain execution skill. They've shown certain growth to you. If you feel that's the kind of growth and passion that still drives you in terms of the company and the founding team, I would not mind paying a slightly more premium just to be in that company, right? So if it's a space that's going to disrupt the entire uh, current market, so if it's like in fintech, if like today in cross-border payments, a payment you make in India will reach cross-border nothing less than 3 days, and if it's return, it takes up to 15, 20, 25 days for cross-border payments. Now, if there's a company which is coming in and saying that, look, I can do a cross-border payment like a UPI, so you would get um, uh, payment in India from Singapore or US in 10 seconds or a minute, I would not mind paying a premium just to be in that company, because I see a lot of disruption happening just by the virtue of that solution being available. So it again depends on what kind of company you are evaluating, but largely if it's a pre-seed, you're looking at the dilution. If it's a certain revenue number, then you're looking at comparable multiples from the data that's publicly available. But if it's a disruptive space, then there is no real guideline, and I look at that. If it's a disruptive space, what's the kind of impact it'll have if and when it matures, and then I'm willing to pay a premium on it. Uh, and let's say on all these three things that you've still not been able to make up your mind, then the fourth thing that I resort to is that if there is a co-investor who's coming in and it's a respectable co-investor, if they are willing to give a certain valuation to that startup, I would assume that they've done their due diligence, and I would like to go along with their judgment.
So long story short, you're just trusting the other guy to do the valuation and diligence. If Sequoia is investing at 10 million, you're fine if given an opportunity.
It builds a lot of trust, right? And if you have no other data to look at, right, you need to trust somebody.
Right. But is there something similar in the listed space, Krishna, like finding undervalued stocks? Because listed space, there's a lot more data, and you do a lot more analysis on figuring out whether the stock is undervalued or overvalued. First of all, does it even exist? Do undervalued stock exist, or is just a misnomer? Like people have read too many books and thought, hey, we just want to buy undervalued stocks. Is that even possible to do it for regular guys, or professionals like you is the only way, like PMS or AI?
So it is definitely possible. Somebody with the interest, inclination, and time can definitely do it. There is no doubt. Again, there are different approaches, right? And there is no right approach. One thing is, there is a very very high level of correlation between the earnings of a company and the stock market performance and the stock's performance. In fact, it's as high as 86%. So end of the day, at least on the listed space, earnings is what drives stock prices and returns as an investor. So the way we kind of look at it at a very high level is what are the 2 or 3 or 4 triggers which could really boost a company's earnings, right? It could be some huge capex that they are undertaking, because of which they could become huge in a few years, or it could be some industry level changes, like something manufacturing moving out of China to India in a particular sector, for example, which was happening in specialty chemicals. It could be um a high operating leverage business, right, where it could be like a platform business wherein the fixed costs are kind of fixed, while the uh, with the increase in volumes, the business can the earnings and the sales and the earnings can go through the roof. For example, if you look at the fintech or the financial infrastructure industry, like CDSLs of the world, or exchanges of the world, they had a great run post COVID, because the infrastructure was there, the costs are fixed, uh, and if a boom, there was a boom in the number of people opening demat accounts, number of people trading, number of people coming into equity markets, and so their sales went through the roof, and because their costs were fixed, their earnings went multiples higher. Those are the kind of calls you need to take. They may not be undervalued today, but given what a company is doing, and this is where you can make that difference, right? Given what a company is doing, if you are able to see visibility in terms of this company can really grow its earnings, and given that earnings is so closely linked to share price performance, uh, then you can probably take bets on a few companies that, okay, because of this reason, this company is going to do better earnings, uh, and hence do perform better. So that's the kind of approach you'll have to take. You may not have anything which is undervalued today, because, as you rightly said, if it was undervalued, everybody would have bought it by now. It's more taking a call on the management and what steps they are taking to make this company big.
Yeah, because that's what we also read. Like there's a book called A Random Walk Down the Wall Street that talks about markets are broadly efficient, public markets. So it's difficult to consistently pick undervalued stock. That is what the book says. But Krishnan and Pankaj talked about disruption, like because startups are known for disruptions. Like, so is it possible for public companies to be disruptive? And can you bet on those companies? Is it even possible to know? Like, first of all, are public companies disruptive? Can they disrupt the sector they operate in? And second, if yes, how do you find such companies?
So yes, of course, can be disruptive. They can be disrupted and be disruptive. The biggest example has been Apple, right? And Apple stock was nowhere for multiple years before the iPod was launched, and then rest is history, right? Then stock price went up 10,000 times, and earnings, they were clocking a 40% quarter on quarter earnings for more than a decade, right? So and almost everything came from the new products. So a company which can in India, we don't have apples in India. We are not a technologically disruptive nation. Even on the manufacturing side or services side, we don't have a global player like this. But for example, you can look at Reliance, right? It's just an example. They have been coming up with new businesses. They are trying to disrupt different industries. So a company needs to keep innovating, keep moving the bar higher. Either so there are two kinds of companies one can look at, where they are disruptors coming up with new products, new industries, etc., or which are very few and far. Or India, we are in a lucky space because the landscape is so wide, and the opportunities to make mistakes are there, right? So the growth opportunity is high. So as long as you are in a market which is big, and you are a dominant player, you can remain a dominant player for a very long time with a high market share. So we can ride on those investments, right? So if there is a dominant paints player, he is likely to remain dominant. He has been dominant for 40 years and likely to remain dominant for the next few years, because of the and the market is growing, and the country is growing, markets are growing. So even if you're not a disruptor, if you're a leader, and you have an efficient business, and you have a great return on capital, and you have performed, and you're likely to perform, and it's a core demand and core requirement which is only going to grow, there are enough opportunities for us to invest in. But pure play disruptors at the scale that we are talking about are far and few, at least in our country.
Yeah, got it. So yeah, of course, that's what we keep hearing disruptive companies so much in startups in India at least, not so much in public equities. I think we're almost done here. One final question for both of you, since I think two or three people asked this question about funding winter. What we are hearing is capital flows are drying up in India, both in listed as well as unlisted space. As US has increased interest rate, other macroeconomic reasons, we might see few like lesser money coming to India. So, what are your views, Krishnan, on the public equity and Pankaj on the private equity side? How will the sectors be impacted?
So clearly, it is tough, right? And India has done comparatively better compared to the rest of the world. Uh, our markets have been more resilient. And that is not to say that people have different views. So one must look at it from a longer term, right? From a very short term, yes, it is difficult. But in India, the thing that is changing, or uh, one has to step back and look at the bigger picture, right? A low single digit percentage of the population pays taxes, and even lower single digit percentage of the population invests. Okay. uh, so there is a, as the market grows, the flows will increase because more and more people will invest. So there is a lot of tailwind in this industry, and which is why one has to be, or one what we are bullish on markets in the long run. Also, the domestic money, unlike before, has become a much bigger factor compared to FIIs, to such an extent that it is becoming a bigger factor today. And 10 years back, 5 years back, you can almost say the FIIs pull out money, markets fall, and FIIs invest, markets go up. And it was very easy. But now, with domestic money becoming an important factor, the funding winter is likely to have a lesser impact on public markets.
Your thoughts, Pankaj, on funding venture, startups, venture capital? We can't hear you, Pankaj.
Sorry. So I'm a little more bullish, and just looking at it from a very broad, uh, 10,000 feet perspective. In the last 100 years, we've seen two world wars, multiple political and civil wars, but we've seen the value of investments rising and rising through the years, through the decades. So what it means that is that the value of public or private investments will and should continue to go up as long as you're in the right country, and I think India is the best place to be in at this point in time. Having said that, at a micro level, in the angel or the startup space, you can get a little sense of when's the winter coming and when's the spring back, is because these the money in the startup ecosystem is largely getting pumped in through funds, and these funds have had a drawdown. So if there's a weak sentiment in the public market space, that tends to translate into a weaker VC interest, which means it has a lag of about 3 to 6 months. So if the public market is weak in month one, you should see a VC funding winter only at the end of month 4 or 6, because the already drawdown capital that these funds have, they need to be deployed in a certain period of time. So you can get that sense, and then you can plan your investments accordingly. Similarly, when the spring is coming, like every winter, there's going to be a spring. When the public market sentiment starts to build up again, that's when the investors get a lot more comfort, and then they start, uh, you know, uh, then the VC start calling their drawdowns, the next round of drawdowns, and once that money comes in the VC funds, then you see more investments happening. So, from a investor perspective, it's relatively, there are more hints that are available to you versus a public market, and you should plan your investment journey accordingly. But on the larger uh, perspective, just a broad picture, it's going to be a spring after every winter, and I wouldn't read too much into the short term uh, ups and downs. And because in any case, your startup is invested for 4 or 5 or 10 years kind of journey. So you can't really do much about it in a particular event or in a particular month or a year. So you judge everything from a little more in terms of time, broader perspective.
That's very encouraging, Pankaj. Many thanks for your upbeat attitude. Because the general feel I get from founders is a lot of founders keep asking that, hey, markets are crashing, stock investments are not doing well, will be able to raise capital. But going by what you said, I think the outlook is much rosier than what we like to see.
Yes, I'm a permanent bullish
Yeah,
person.
I'm sure so is Krishnan. But thank you guys. Many thanks for your time. It's been a super insightful session. And everyone, like, if you just want to watch it, you can watch it on our LinkedIn page or Pankaj and Krishnan's profile. It will be there for a while. I think for 1 month. All right, guys. Many thanks for your time on taking out time on Saturday.
So welcome. So I had one last thing. So, like Pankaj said, we say it as in markets, right? Bulls make sense, bears make sense, but bulls make money. So be a bull.
Yeah. So Pankaj is the big bull, I would assume.
No,
All of us.
the big bull is guiding us.
Yeah.
All right then. Thank
Thank you
you.
so
Bye.
much. Bye.